Hey guys, welcome back to the channel. Today's video, we're going to be diving into a hot topic for anyone who is serious about retirement savings, and that is why I prefer a Roth IRA or a Roth 401k over the traditional variation, and why exactly you might too. Now, I want to break down the pros and cons of each of these, give you real world examples, help you make the smart decision for your future. So let's stick around to the end of this. So let's start with the basics. The 401k plan is an employer sponsored plan where you contribute pre tax dollars, your money grows tax deferred, then when you pull that money out during retirement, you pay the tax. On the other hand, or the flip side of this, the Roth variation is funded with after tax dollars, meaning there's no immediate tax deduction in the year you make the contribution. But the huge advantage when you take your money out for retirement, it is completely tax free, including the growth. So essentially, with the 401k, a traditional 401k plan, you're postponing the taxes to a later date. With the Roth, you are actually paying the taxes up front. So why do I prefer the Roth? Now, when it comes to the Roth, it is the tax-free withdrawals, which is huge. Tax-free withdrawals are an absolute game changer. You know exactly what's in that retirement account. You don't have to worry about the taxes. You don't have to worry about what your tax bracket is going to look like in 20, 30, 40 years. Also, with the traditional variation, you're going to have to pay taxes on the growth. With the Roth, you do not have to worry about that either. Secondly, the Roth gives you a lot of flexibility. You can withdraw your contributions, not the earnings, but any contributions at any time penalty free. That means if you have to tap in there for a true emergency, you wouldn't get destroyed by your taxes and your penalties if you are of a certain age. Third, you generally have more investment choices if you're choosing a Roth IRA. Now, when it comes to 401ks, you're kind of limited to what mutual funds or funds in general that your employer chooses within their plan. If you're choosing to invest in a Roth IRA, you can basically pick any stocks, ETFs, mutual funds, REITs, anything you want to build up your portfolio. And the fourth and final one in here, no required minimum distributions. This is the massive one when it comes to IRAs. You don't have to worry about required minimum distributions. You do not have to pull money out of this account if you do not want to. When it comes to 401ks, they force you to take money out at a certain time when you're at the age of 73 under the current rules, whether you need the money or not. So this removes your ability to continue building that account and continuing that compounding interest because you have to take those RMDs. And with those RMDs, you are also required to pay taxes at that point. With the Roth variation, you can let it grow forever if you want to pass it on and create generational wealth and pass it on to your heirs. Now, why I think really a 401k still does have a place. 401ks definitely not useless, especially again, if you have that Roth variation. The biggest thing, the employer match. If you are not getting the employer match, you're absolutely throwing away money. If they give you 3%, 5%, 7%, the matching contribution is literally free money. There is not a place that I'm aware of that you're going to get guaranteed a 100% instant return on the contributions that you're getting in there and you're putting in there. This is the reason when it comes to budgeting strategies and when it comes to financial literacy, I always say the first thing you should do is get that employer match, which is absolutely awesome. Now, of course, when it comes to 401k plans, they have higher contribution limits. This means when you look at 2025, you can put $23,000 in there. And if you're over the age of 40, you can even put more. Now, when we start thinking of the IRA variation, you're maxed at 7,000, depending on your age, but 401ks can absolutely supercharge your retirement savings. But two things you really have to be aware of is number one, what are you investing in? And number two, exactly what does it look like when it comes to taking that money out or moving the money, which can make a really big difference. If you want to supercharge that retirement savings, 401ks can be very useful, but making sure that it does have, again, that Roth variation. Now, of course, with this, finally, you can do straight deductions. This is dollar cost averaging at its finest and really in its purest form. Your 401k funds come straight from your paycheck right into an investment account. You don't even see the money. There's not a chance that you could go ahead and use it for something else or end up not investing it into that IRA account. Now, that's great for us building a really solid foundation when it comes to savings. So let's look at two real world examples. And I want to show you, say you're 30 years old, you're making 70K a year, which is roughly about the annual salary. Expected income, of course, going to rise over time because you're only 30 years. You can get raises, you can get promotions. At that 70K, you're at a relatively low tax bracket rather than what you might be in the years to come. This is why an IRA or really that Roth variation makes incredible sense. You're in a lower tax bracket. you're going to be in a higher tax bracket in the future. The money you're putting in is going to be taxed at a much lower bracket because that's exactly where you are. And then you can take those withdrawals later when taxes might be higher. Now, of course, another one in here, let's say, for instance, you're 45 years old, making $150,000 a year. You might want to do a 401k. That is the traditional variation because of the tax advantage that you're seeing today, because you are in a higher bracket. If you are sitting in that higher bracket, if you have dual income, might make sense to go in and do the traditional variation. Again, just to really relieve some of the tax liability today. Even doing a Roth IRA later, you could once you do hit those 401k limits. But you also do have to remember, when you think of bigger picture, and this is the way that I always seen it, is if you're making contributions and then you compound on the growth, by the time the account gets to a very sizable account, you could have to pay taxes on that if you are doing the traditional route versus doing the Roth route, which again, it might be a little bit lower on the contributions because they are after tax versus pre-tax in contributions, but the way that it's going to be treated throughout the years. But I would rather get to a point where I know exactly what I'm paying in the future. When it comes to that Roth variation, I don't have any surprises, and I could even actually get to retirement, be in a much higher tax bracket than I was during my working years due to the fact that the account built to $3, $4, $5 million. Now you're required to take the RMDs even if I don't need the money. And all of a sudden I am in a very high tax bracket because I have to make those RMDs, those distributions out of there. So what is the bottom line here, guys? I absolutely prefer the Roth variations of the 401k and the IRA. Gives you that tax-free retirement income, gives you flexibility. You're not forced to take out the money, and you have the control over your investments. But the best strategy is both really taking and making sure you're getting that 401k as well as IRAs, putting as much money as you can into that Roth variation. You will absolutely get the best of both worlds. So if the video helped you, definitely consider smashing that like button. Subscribe for the channel because we are doing financial tips. Comment below, what do you prefer? Are you looking at a Roth IRA? Are you looking at a 401k? And does your employer offer a Roth 401k? I would absolutely love to hear your insight. Thank you for watching, and I'll catch you in the next video.